Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. And I sound funny. I think it's the combination of things. The fact that I caught one of those viruses that's going around and some funky headset on. Anyway, as the man said, this is the Bullington Capital Report. Coming this week. Actually, week was kind of, it's been amazing. I think the market's kind of on hold until they find out who wins the election. Yeah, I haven't seen a lot of activity either way, actually. You look at the past couple months, market's exactly where it was back in the beginning of July. So, hasn't really done much other than stay in a narrow trading range, which I'm fine with. And if you were to look at, or if you believe anything that William O'Neill says, got a cup and a handle pattern in the S&P 500, and in this case, the handle is above the cup, which passes above 2,200, could be off to the races. Something I've been talking about and thinking about now for the past, probably 6 or 8 weeks. As you look at how many styles have gone out of favor, how many stock investing styles have gone out of favor, and people are getting up on them, now is probably a pretty good time because they've been out of favor for long enough to come back into favor. And that's typically what happens. You're value-oriented investors. It'll test your patience every time. As soon as you find something that's a good value, normally it's a good buy because people are afraid of it. If everybody loves the stock, there's no bargain there. But when everybody's afraid of it, that's where the opportunities rise. And oftentimes that initial fear is reinforced by further fears, which causes the share prices to drop even further. And at some point in time, it will start to go up, but it can be very painful on the way down. So that's the struggle behind value investing. The struggle behind growth or momentum investing, many times they're the same. Oftentimes people ignore price movement completely and just focus on the sales or earnings growth. And so there are different types of that. But there's another type of investing called momentum investing, where you could combine price movement with fast earnings growth. That's the way that William O'Neill likes to refer to it. Or there are a lot of people that just use price movement. We're going to be using price movement as a subject of the next seminar that we have on October 6th. That's at 6:30. Starts at 6:30. I should say that part starts at 7:30. 6:30, we're going to get together and do an informal stock talk. I've talked long time about individual securities, what you look for. I've got a little ebook that's almost done that can help you tremendously cut your learning curve and find out really whether or not you even want to be involved in stocks. A lot of people don't. Now, I'm going to tell you today that you're going to have to be involved in stocks if you don't win the lottery or if you don't build a hugely successful business. Why would you have to be in stocks? Because you won't make any money in bonds. And I hear some guy on CNBC the other day saying, well, he thinks the stock market's returns are going to be much lower and very low over the next 5 or 10 years. I'm going, yeah, but it's better than zero. You have don't listen to most of the things you hear on television or radio, my show included. Go Google it. You hear what somebody's saying, and it sounds like it maybe it sounds too good to be true, or maybe it sounds like it's gloom and doom. Just go check it out. When you get 4 or 5 sources that you feel like are credible sources, and they're all in agreement, and you're probably onto something. Now, having that happen is rare, by the way. So when it does happen, you know that pretty much you're onto something. So I'm getting off the subject here, mainly because this week has been rough. There's a virus going around, and I don't know. I caught one of the versions of it, whatever it was this week, and it's really put me out of commission for a couple days. It's one of the reasons my voice sounds the way it does. But so if I seem kind of flighty, feel free to call in and remind me to talk about the topic that I started before I wandered off. If my office people do that all the time. Nobody gets offended. I don't get offended. If I start talking about something and I change the subject and don't come back, you call me up on that. Let me make sure. And I want to make sure today, too, I want to talk about some individual stocks because there are some pretty good stock picks. Some great-looking charts from companies that have excellent underlying fundamentals. That's a pretty good thing. I haven't seen that in an incredibly long time. I've seen some great-looking chart patterns, and then the charts break down. Stocks start going south. But I haven't seen good-looking stock chart patterns from companies that deserved to be going up in quite a while. And part of what I had alluded to earlier today, there were some momentum investors that were very popular. Marsico, I'm not even sure if that's exactly how you pronounce his name. He used to run the Janus 20 fund back in its heyday. This guy was, it was a phenomenal stock picker. Had a great track record. Went out and started his own firms. Still had a great track record. Gets to $100 billion in assets. At $100 billion in assets, you just can't do the things he was doing when he was managing $1 billion or less. It's impossible. You're too big. So his performance has waned over the past few years. Two reasons. The style itself was out of favor. It comes in and out of favor. It's pretty cyclical. The cycles are relatively long. By long, I mean multi-year cycles. So on top of the fact that he's grown enormously large because of the success he had when the philosophy that he uses was in favor, okay, he's got all these assets now that he's got to manage, which would be incredibly difficult even if the conditions were right, but then the conditions turned wrong. And they've stayed wrong for an incredibly long time period. So this guy's back down to about $3.5 billion in assets. I mean, 97% of the assets have pulled, which tells me that style is about to come back in favor because it's just exactly how this has a tendency to work. It'll say you'll stay wrong enough, long enough to eventually change your mind. And when you do, whatever you were doing tends to come back in favor. And that's the bane of all investors, by the way. The average investor, according to Dalbar, market research firm, they don't manage money. All they do is do this research, and they sell it to the money management firms who buy it from them. So they track investor behavior, and investors do the same thing. What's amazing is that the institutional investors behave very similarly to the individual investors. You would think that they would have more sense than that, or actually because of their studying would have a bigger advantage than they do, that would prevent them from duplicating a lot of the things that individual investors do, but they don't. They get into a strategy that's been hot, it's been working, it's been wonderful. When it goes cold, they bail. I will say that the institutional investors have a tendency to stay a little longer. They do stay a little longer. But when this particular strategy that they've been bailing on has been out of favor for 3 or 4 years in a row, you might want to pay attention because they tend to miss those turning points. So do the individual investors. And this is why it pays to be a true contrarian. Everybody wants out. You should start looking around. Everybody wants out of something. You should be paying attention to it. It's like the MLPs. Everybody wanted out over those, earlier part of this year. Good reason. They were down a lot. I guess that's a good reason. Yeah, my mind, I'm looking at it going, wow, this guy's their revenues were at an all-time high, and their distributions were at an all-time high. The only thing that's low is the share price. The yield was at an all-time high. Now the yield is a lot less, still pretty good, somewhere around 6% or so on tax-free. That's pretty big, isn't it? Especially in an interest rate environment where you're going to be, below 1% for the foreseeable future. I know they keep making a lot of noise about changing. They're not changing interest rates. Not substantially. It's just not going to happen. Way too much debt. you start adding on $140 billion worth of increased debt payments, from increased interest expenses, you won't stay in office very long doing that. I don't care who you are. You're not staying in office very long if you start allowing the interest rates to go up like that. By the way, the Fed could kind of control who gets into president. If they decided to raise interest rates and shut the economy down, they could do that. Lickety split. And whoever was in office, the other party would win. It would have nothing to do with the presidential candidates. Anyway, that's a whole other radio show, I guess. So I'll get back to the momentum investing, which has been out of favor for a very long time. Everybody hates it. Nobody wants to be in it. I run 2 momentum strategies. Yeah, they've had a tough run over the past couple of years. Because mine are relatively smaller, because the funds I run are smaller, we haven't done nearly as poorly as a lot of the other momentum styles. And when you come to the seminar, I'll show you why. I'll show you exactly why. In fact, one of the models I'm going to let you take home. One of the models that I use, I'm going to write it down and pass it up. You can take it home with you. And you don't even need, actually, you could do it with a Chromebook. I was looking at the Chromebooks. Those are computers that are basically made just to get on the internet, and you use all Google Chrome stuff. It comes with Google Chrome built into it. Chrome, by the way, Google has a set of programs they call Google Docs, where it's got spreadsheets, documents, and like a PowerPoint. You can even edit video and edit photographs. And these things cost under $200. They look like regular laptops. And it's pretty wild. When you think about it, most people, that's all they're doing on their PCs anymore is getting on the internet, because all the tools that you need are available online. And so you've got these really nice looking laptops, very functional, under $200. I actually feel bad for kids, but a high school kid, there's no way you can't afford you could go out and shine shoes and make $200. In fact, you need less than $200 for that. But some kids, I still feel bad for. Bad households, where there's just not a whole lot of money. Something like that's going to be seen as probably frivolous. I get it. It's not, though. These are necessary tools. And the good news is that those tools are within reach of most people now, the vast majority of the public. So, man, am I digressing? Let's see. Hey, don't get sick. This is not age-related, by the way. This is the whatever the bacteria was that the hospital couldn't find. You should see my arms. They took so much blood, and they missed my veins so many times. I look like a junkie. I got bruises everywhere. Crazy. Anyway, so we're going to talk about the momentum investing. That's going to be the main theme of the workshop. But prior to that, we're going to talk about individual stocks. I'm going to show you the scans. I haven't brought these out in a long time. I did get a new computer, by the way, just for the presentations. Wasn't very expensive either. I'm amazed what you can buy for under $500. That blows my mind. But so I got a telechart. That's the software that I like to use. It's relatively inexpensive. You can combine that with a couple of other things to make this much quicker. And there are some companies out there right now look like they're really good deals, and they came up on the momentum chart. Now that's really how I prefer to do value investing. I like to get a good deal, something that's selling below where it normally would by a lot. That's what I call a good deal. I don't call a good deal something that might go up 20%. I am not interested in that. What I call a good deal is something that is undervalued by at least 100%. In other words, it should be selling for twice what it's selling for. And I'm going to show you how to calculate that on the back of an envelope. It'll take you about 5 minutes once you get it down. I'm going to show you the resources that you can use online to find that information. And I'm going to go through several names that I own personally right now. So I just bought within the past couple of weeks. And I only bought half my positions, because after the seminar, somewhere over the next quarter, I expect to increase the positions in these several stocks. So if you want to find out about that, that's actually going to start at 6:30. We're going to call it Stock Talks. we were going to have a investment club at one point in time until everybody found out how much work it was. Paperwork, a lot of paperwork. You've got to be a limited partnership. Basically, you're filing as a hedge fund, and you have all the reporting requirements that hedge funds have, which are amazing, amazingly complex. That is, and that's one of the things that we've gotten from this. One of the gifts of this past administration is a whole lot more regulation. Anyway, I've got to take a real quick phone call. You can call in today, too, 216-901-0945, 216-901-0945. I'm going to go to John in Chardon. John, how you doing?
Good, Bill. Hey, I was listening to the program this morning, and then I got a phone call. So I had to turn you down.
Okay.
And I got done with the phone call, and I turned you back up, and I heard you say something about 6% tax-free.
Mm-hmm.
And I'm wondering what that, my curiosity got the best of me, so I had to call.
Well, those are the MLPs, which you already have a lot of experience with. Over the past 18 months, experience hasn't been very good. But
as far as the price of the stocks, yeah.
But you know what? Their distributions at an all-time high last year. Another good sign, an MLP just came public, just started trading this past week, and it came public with a yield of 7%.
Wow.
And,
which one was that?
I'd actually have to look it up. I can't remember. I just remember reading about it and getting the yield and going, oh, that's nice. Yeah, that's great, because they wouldn't come public if they weren't confident in the timing. Yeah. They don't come public to go flat. Nobody wants to be disappointed by a stock going public. And
right.
So
it's a pretty good tax situation too with the MLP.
Yeah, it really is. And one of the things that I think many people confuse is they think it's tied to crude oil prices. Crude oil is not the major product being carried through pipelines anymore. It's natural gas. Yeah. And there is a lot of crude oil. Don't get me wrong. And it's still a major piece of that. And the volumes of crude oil have actually increased through the pipelines that are transporting them. It's just that the drilling and the new production has slowed down because the price has gotten so low. But at some point in time, I got to take a real quick commercial break. You want to hang on? I'll come back right after the message.
Yeah, I got one thing I want to just tell you about.
All right, that sounds good. Listen to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
I can't wait till I see you again.
And we're back. Hey, John, you still with me?
Yeah, I am. You know, one thing is a specific. Kinder Morgan, they went from being an MLP to not being. They gravitated to not being an MLP.
Right.
And their dividend dropped significantly.
Sure. And, well, they have to pay taxes now. So before, if they paid out 90% of their funds from operations, they didn't have to pay a corporate income tax. Now they do. So that would cut the tax by at least 40%.
So it's just like an ordinary stock now that doesn't pay very much.
Yeah.
So I'm thinking about selling that and buying the NLPN. The NLPN. What do you call it? Anyway, buying that. Buying that.
Yep.
Yeah. Anyway, I think that might be a good move. But anyway,
I think it probably could be.
Yeah.
There's at some point in time, I think people are going to be incredibly surprised. You know, natural gas took over coal's position as the single largest resource for generating electricity, material that they use to generate electricity. And at least I believe it did. It may not have. I'll have to double check that. I know it's been growing substantially. That's why the MLPs have still been able to increase their sales and their distributions. You know, primarily natural gas pipelines. which, by the way, Warren Buffett happens to be the owner of a company that's the single largest pipeline company in the country. And he owns a railroad. So he's kind of like the guy who sells guns to the cowboys and the Indians. It doesn't matter which side of the war wins. He's got both sides covered.
Which one is that he?
Mid-American Energy, it's a utilities company.
Yeah, okay.
Who's using a lot of natural gas to generate the electricity. And, natural gas burns so much cleaner than coal does. And and the price on it right now is so low, it's really become the fuel of choice to kind of generate electricity right now. Put a lot of pressure. Put a lot of pressure on a lot of other industries. I mean, put a lot of pressure on the coal industry. Put a lot of pressure. There are still some facilities that actually burn petroleum to generate the heat to create electricity. So it's pressured them. And low natural gas prices have been good for us, the consumer, because it's reduced the costs fairly significantly. But it's really hurt a lot of other companies in a lot of different industries. So.
Yeah. Well, of course, the political aspect of the thing, if she gets elected, I'm hearing on the news that she's going after, of course, coal and natural gas, too,
Good luck. I think that's rhetoric. I don't think that's,
okay.
I really don't believe that. But you hear anything if you listen hard enough.
I suppose.
It's kind of like watching clouds. You can see just about anything if you look long enough in the clouds.
That's true.
Yeah.
All right, Bill. Well, thank you.
Well, thanks for calling. Thanks for listening.
No problem.
Talking to you soon.
Thanks for your advice.
Oh, no problem. Thanks.
Okay.
Bye-bye.
Bye-bye.
And if you have a call, question, or comment, 216-901-0945. You can also go to my website, bullingtoncapital.com, to sign up for the upcoming workshop. By the way, I have to look back at the date of that because I have two of them coming fairly close together. And this one is October 6th. That is a Thursday. We're going to do the Stock Talk, 6:30. We're going to take a little break. It's only going to be 45 minutes, very informal. Then we're going to do the Momentum, where I show the one model I'm going to give away. Everybody that comes is going to get a copy of that, take home with them. And I'll show them the other models that I use and how you might be able to use that on your own, which I always think is a lot of fun. And stocks go from being fun to being boring to being dreadful, back to being fun again. Just kind of like real life, actually. That's a lot of ups and downs. And I'm telling you, the things that really get me excited about this particular market. It's been so volatile and so choppy sideways for so long that people are starting to give up on it. And the more that they give up on it, the closer we actually get to a big run starting to happen. And I'll come back to that as soon as I answer this phone call from Don in Fairview. Don, you had a question?
Yes. Back a few weeks ago, you had mentioned on your show you were going to look into referrals for health insurance.
And I have found one. I didn't bring my, I forgot to bring his card with me today.
And this is somebody that you have great confidence in?
His reputation's pretty good. So that's about all I can tell you. We got a lot of interference there with your phone. Are you on a cordless phone?
No, on a landline.
Oh, wow.
I've got another question. I've been hearing about long-term care benefits that is associated with either a life insurance policy or with an annuity, and return of premium if the benefit is not used. And it sounds kind of interesting. What do you think?
I think they're worth looking at. There used to be some pretty good products in that area. I haven't looked at it in an incredibly long time. I know they're not as popular as they once were because the costs of nursing home care have risen so quickly. But it's made it really difficult.
From what I understand, when you buy the benefit rider or whatever they call it, it's a fixed amount, and the cost is a fixed amount. Before, I guess, you'd pay so much and you'd get a monthly benefit, and then, of course, the cost went up and they'd increase the price.
Well, here's what's happened in that industry, especially in the nursing home care. They came out with fixed costs, and inevitably the companies had to go back and raise those costs, even though they said initially that you wouldn't raise the costs. So I'd be really careful with that. Long-term care is a tough situation, and we'll focus some more on that in the future, because I'm trying to line some guests up who are specialists in that area, and because it's very important. That's an incredibly large expense if you have to go through it. And about 1 out of 2 people that reach age of 65 will actually have to go through it at some point in time. So, it can be a major expense. And there are lots of products out there. Some of them are pretty good and some of them not so much. So the not so much products have a tendency to go away at some point in time, because eventually people figure that out. But and there are some good ones out there. It all depends on your personal financial situation. There's no one-size-fits-all answer that you can say this is always going to work, but there are a lot of good ones. So it looks like we actually lost that call. If you'd like to call, 216-901-0945, 216-901-0945. And a little bit later, after the next break, when we come back, I'll do a little bit of a preview, some of the stocks that I've purchased in the past couple of days. Not big positions, because when I talk about this, I'm really talking about a relatively small percentage of my money, 25% or less, that I'm breaking up into 5 to 10 positions, and I just because I like doing it. I would not recommend that you do this with more than 15 to 20% of your money. It's just not worth it anymore. The risk you take is too great. Those kinds of things are what we're going to be talking about at what I'm calling the real seminar. The first part is just an informal conversation, stock talk. Real seminar, I'm going to roll out real strategies I think you could use with a fairly significant portion of your money that you would have allocated to stocks. Okay, so the bigger stuff, the more important stuff, that's what we're going to be talking about the second half of the workshop. The first half, we're going to be talking about the things I just like to do, which have been very helpful, over the years. You look at the number of winners that have come through there over time, and how much it's helped the entire portfolio value. It's a great thing. I think everybody should have some experience in it. It's just my personal opinion, my personal bias, because if you don't, you have no idea what the stock market's really about. I mean, it's one thing to hear it. It's one thing to see it on paper. It's another thing when your adrenaline's flushing when you hit that buy button, especially when one of the stocks that you just bought comes out with news a few hours later that's really bad and the stock's plunging. You can't get that experience looking at a book. But you also get the other thing. You buy something, and the next day or within the next few weeks, a buyout offer comes 25, 30, 40% higher than what you paid for it. That's awesome. You do it long enough, that'll happen too. And anyway, I got to go back to Don. Don, you got a better phone line for me.
Right.
All right. Yeah, this one sounds a whole lot better.
Good.
So, can I? Where do you want me to pick up?
Well, we were talking about the benefit rider on a life insurance policy or an annuity, and with the return of premium if the benefit wasn't used.
Yeah, I'd have to look at the individual policy, because every policy, there are thousands of products, and they rewrite the rules all the time. So that's kind of a one-off situation where you've got to look at each one of those things that you're being presented with. And to actually keep up with all of them, you have to be a specialist today. There's no doubt in my mind that that's going to be your specialty. There are just too many. Just too many products out there, too many insurance companies offering differing products with differing benefits, features, and costs. So
right.
And it's not an easy thing to do.
Yeah. Oh, on next week's show, would you have the name of that referral?
I will definitely try to do that.
Very good. Talk to you then.
Okay. Thanks. Yep. Bye. Yeah. In fact, we have networks of people to talk to in all areas. Actually, the health insurance was actually one of the latter ones, and it came from a referral from one of my clients. And that's typically how you find most people in, at least I find it is, you ask around, you get referrals, and then you talk to them. So after you've talked to them or tried to check them out, you can go online, and now there's, FINRA, if they're registered in the securities business, they've got a background that's up there, and there are better business bureaus, all that kind of thing, Ohio Department of Insurance. You can do some slight background tests. Those aren't always very effective, but yeah, it's better than nothing. And just talking to them, and my suggestion, I hear this stuff all the time, is talk to people, find out who you feel comfortable with. Find out who you feel comfortable with. They don't have any glaring discrepancies in their proposals. So oftentimes you'll see that they'll say one thing, and then you look at the actual proposal they put down on paper, and it's different. That to me is a kind of a red flag. Immediately, I'm really just not comfortable doing that. So make sure they're consistent. Sometimes it might seem that they're inconsistent. I know people say that about me oftentimes because they confuse trading and investing, and those are not the same things. You can try doing both at once, but I don't do that. Actually, occasionally I will. I take that back. Occasionally I will. Typically, I'll look at something as either A, trade, or B, a long-term investment. And those are different. And I can't tell you how many people still come up in a seminar, ask me about a stock that I clearly said was an investment. Well, are you going to sell that if it goes below the 20-day? No. Why not? Because it's an investment. It's not a trade. What you're describing is a trade. And so I guess just some people are just never going to get that. It's like me trying to sing a really, really high note. I mean, I can try, but I'm probably never going to get there. Anyway, I've got if you'd like to call in and ask questions, we're getting close to commercial break here, but the number is 216-901-0945, 216-901-0945, and we'll be glad to take questions. If you wanted to sign up for that workshop, you can go to bullingtoncapital.com. If you wanted to send me a question, you can send it to bill@bullingtoncapital.com or go to the website. There's a request information form there. You can fill it out and request the information there. And right now I'm going to go to Jerry really quickly. Jerry, how you doing this weekend?
Hi, Jim. Or excuse me. Hi, Bill. Could you explain the terminology, the Greek terminology in options trading? There's
in
theta,
this show? In one show?
Well,
are you kidding?
Very briefly. Just what does it mean? One is time.
You can't.
One is you can't. Okay.
You can't describe those briefly. You could take a stab at one of them, and if you've got if you have about 20 minutes, that's about how much you'd have to spend minimally on one of the beta, the gamma, the delta. It's incredibly complex, and I am going to tell you that those numbers are pretty much pseudoscience. They do not work.
Okay. Okay.
I can tell you what the most important aspect is. Would you like to know what that is?
I assume it has to do time, time decay.
Nope. The most important aspect is implied volatility.
Implied volatility. Can you explain that?
Yeah, it's exactly what it says. They're implying the action or the price of the option is implying a certain level of volatility. And I'm way too close to the commercial break, but I'll come back to that when I come back from the commercial break.
Okay, very good.
Yeah.
I'll just listen to what you say off the air. Okay.
Okay, that sounds good.
Okay.
Thanks, Jerry.
Thank you. Bye-bye.
Yeah, if you options is incredibly complex, and you can make it. I mean, it is just wild. And if you don't believe me, just go get the book, Options as a Strategic Investment. You may want to check it out at the Cleveland Public Library. Have them get it for you. It's about 800 pages, and even that is not comprehensive, which is kind of crazy. So when you start getting into options, you're really getting into some really high-level math. And I'll tell you what's really funny is in that book, there's one little passage where the guy writes that the best options strategy or technique comes from knowing which direction the stock is going to go. That's a lot of help. Yeah, anyway. Listen to Bill Bullington right here on 1420 The Answer. We'll be back after these commercial messages.
I saw a werewolf with a Chinese menu in his hand.
And we're back. Hey, just one more shout out. We got the workshop coming up. It's going to be 2 parts. First part at 6:30. That's an informal stock talk. We're going to preview a couple of the stocks that we'll be looking at in that workshop later in today's program. And actually, this is the last segment of today's program, so we're going to get to it in just a couple minutes. The second part of the seminar is actually going to be looking at momentum investing, the other side of value. When the markets move quickly, momentum strategies have a tendency to perform at their best. Come and find out how we plan to participate. I use momentum and value because the 2 basic schools of thought, growth and value. The outside of that, there's just tons of combinations of those 2 in a bunch of different ways. But those are the 2 major schools of thought. So we're going to be looking at the momentum and how you can do it. I'm actually going to give away one of the models that I run through Bullington Capital. And I'm going to write it down for you, let you take it home with you. So you go to bullingtoncapital.com to sign up for that workshop. It's at the Corporate College. That's right off of Richmond Road over there by the big Eaton headquarters. Again, feel free to go up and sign up for that. Should be a lot of fun. And I'm looking forward to it. Of course, I always do. And with that being said, let's get right into, oh, by the way, the implied volatility. Here's the thing. I would go to cboe.com because even trying to explain about implied volatility, I'd end up using the rest of the show. Now, maybe if I get early next week, somebody calls and reminds me, I'll spend more time on it. But I did notice Investopedia. It's a website I've been recommending for years. I look at the definition they have in there, and it's wrong. Oh my gosh! No wonder people are having such a difficult time. The implied volatility is an estimate of the volatility of securities price. Okay, they're saying it increases when the market is bearish, and they believe that assets will decline, and it decreases when the market is bullish. That is not true. That is not true. So go to cboe.com, type in implied volatility, and it'll show you. And what you want to look for if you're doing options, if you're really concentrating, and that's something that I really wouldn't recommend that much, unless you're doing super long-term options and it's an undervalued stock that's come up on a momentum screen, which we're going to be talking about at the workshop, then you can do that. Okay, and it's not going to matter much. Implied volatility is out 2 years from now. Nobody knows what that is. Or a year from now, they don't know what that's going to be. There's no mathematical model that can predict that with any accuracy. That's why I like it, by the way, because there's an inefficiency there. They don't know how to price it. Okay? Where there's an inefficiency, there's an opportunity. That's what we're looking for, market inefficiencies. The other thing that we're kind of looking for is when the market is relatively efficient. What do I mean by that? Well, oftentimes, the big mutual funds, any fund that's above $1 billion in asset, has the ability to move most stocks in the stock market by themselves. And since there are several thousand funds out there that have over $1 billion in assets in them, knowing that they can all move just about any stock you own at any time by themselves, if you wanted to pay attention to the price movements, there's some cues, some keys that the stock may be ready to make a big move. And some of those keys are that you get a big wide range on a particular day. And what I mean by wide range, I mean a price movement that's at least 3%. Here's one I bought on Friday. I didn't put a lot of money into this, so don't get all excited. I never put a lot of money into my trades. I have enough money in there that if it goes good, I'll add to it, and it will be a substantial portion of my total. But if it doesn't, I'm going to get stopped out, and it's going to cost me very little to give it a run, give it a shot. Okay? And that is the real key to being a successful trading investor. If you want to be a successful trader, you keep your losses as small as you possibly can, but put yourself in an opportunity to make big money when you're right. Okay, that's the trick. And a company, I actually own this as an investment. You could own this one as an investment, incidentally, because it has the characteristics of both. So investors, incidentally, actually take more risk than traders do. So when an investor is wrong, the stock is typically down 50% or more before, they end up selling. Why is that? Well, because they don't use stops. And by the time the news that causes the stock to be down 50% surfaces, the stock is typically already down because there are a whole bunch of people that trade on inside information that aren't supposed to. And that's how that works. That's all I have to say about that. Just kidding. I just saw that movie again this past week. I'm laying at home on the couch, wishing somebody would come in and shoot me. Just put me. There's a virus going around, and it is violent. Anyway, so this company, KCG, Knight Capital Group, this is an online brokerage firm. That's actually not true. They're a market-making firm, and they're an electronic market-making firm. I don't know if you've read the book Flash Boys or just peruse through some of the channels. Yep, these are some of those guys. They allow computers to match up orders, and they get paid for that. Their computers will match up orders, and they get paid for that. Perfect looking chart. It was up 7%. I think I bought mine probably near the high of the day, which is typical for me. But it's up 7%, 1560. If you look at the William O'Neill cup and handle pattern, it's actually extended a little bit. There was a cup and handle that came right around 1420, broke out, pulled back. Would have pulled back enough to stop you out, by the way, if you were following that Can Slim formula stuff. And it would have washed most people out, which is one of the things I like to see. I like to see it wash a lot of people out. In fact, this would be the third time that's happened. That would have been that'd have been the third time you'd have gotten stopped out, which greatly encourages me because I know the more times that has happened, the more likely this thing is getting closer to make that big run, and I hope this is it. Yeah, that'll be nice. And I'm going to use a much more lenient stop process on this. I'm going to put it, slightly below the low price that it traded at on Friday, which was up a lot from the day before. Symbol is KCG on it. The price to sales ratio on it is 1, by the way. So price to sales ratio is 1. These guys have potential profit margins that are enormous. This company actually blew up at one point in time. Their computers misfired. They had a bunch of errors. They had to make good on all those bad trades that their computers made and basically put that company out of business. Somebody else came in and bought them. And I'm trying to remember who that was back then. But anyway, this company was not called KCG before. It had I think it was just Knight Securities. Now it's called Knight Capital Group. Yeah, and they had a big problem, a mini flash crash that they caused. I think it was an inside job by one of their programmers, quite frankly. He got mad and set this bug to work and walked out of the business. Anyway, ends up putting them out of business. Somebody else comes in and buys them, pays for the mistakes, recapitalizes them. All brokerage firms have to retain a certain amount of capital in their own accounts. They had fallen below that level. The SIPC comes in and says, hey, you can't operate here anymore. You're actually going to have to find a new buyer or a new capital, raise money. You got to do something. You got to get your reserves up. And they ended up being bought out by another company and merged in with another company. And make a long story short, a lot of these companies sell for 3-4 times their annual revenues. This one's at 1. So if it goes to 2 times, great. If it goes to 3 times, woohoo. And I think I even tried to buy leaps on this, but I'll have to go back and review my trading records. I know it came up on my screen. I got all excited about it because I liked the chart pattern. I was familiar with the company. I look at the valuation. The valuation's low, and I'm in. Now, again, don't put more than 2.5% of your total net worth in a company like this if you're going to trade it. going to do like I'm doing. Don't put a lot of money into it. If it takes off, you can add to it on the way up. That's how professional traders do it. They don't average down, they average up. When you're ahead right away, those tend to be your best trades. The ones that take off right out of the chute tend to be your best trades. Those don't happen that often. That's why you want to maximize those and add to those positions, not be pulling away from them. And anyway, and again, we're going to cover a lot of this stuff at the workshop. I think this is a lot of fun. Archer Daniel Midland actually came up. AMD, they're one of the few competitors left to Intel. And its price to sales ratio is 1.3. The average for that industry is 4.5. It's been a long time since I've seen that. Actually, it came back up. It came up on scans a long time ago, but I had set my scans for only stocks above $10, which I recently just took away, and I put with a minimum market cap of $200 million because too many companies had gotten beaten up so badly. Their share prices were below $5 a share, but they were still worth several $100 million. So that's big enough to trade for a mutual fund, and I'm kind of concerned about that when I'm looking at trading. I want companies big enough to capture the attention of the mutual fund industry or the ETF industry, or to become a major, become a component of an index. So size matters. And that one had a pretty nice looking chart. It's had a pretty nice run going forward. There was another one. GoPro. So GoPro comes up, and it's actually been coming up. It's come up twice, 3 times in the last 3 months, actually. I didn't buy it any one of those times. I bought it on, it came up on Thursday, and then Friday had a nice little day. I hear the music. That means my show is probably really close to being over. Hey, listen, we'll continue this conversation next week. Feel free to give me a call in the office or go to my website and fill out the contact us. We'll get in touch with you. You've been listening to Bill Bullington on Bullington Capital Report here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.